So what you need to know is that for today, the focus is not on how much the rate increase will be itself from the Fed. Rather, more people will be looking at the language surrounding the hike. All eyes will be on what Fed Chair Jerome Powell says in his speech today. And here to talk to me about this is Joseph Trevsani, senior analyst at FX Street. So now 25 basis points pretty much expected at this point, but what do you expect with the language from Jay Powell?
Well, thank you for having me. I think this is going to be one of the more tricky news conferences, and also the language perhaps in the statement that the Fed has had in a number of years. I think they need to pause. I think they're going to pause after this, but I don't think they're going to announce a pause. I think they're going to try and keep their options open, and they're going to say, well, we have reached the end perhaps of what we projected to begin with. Inflation has diminished. It's certainly not conquered, and we're going to assess. I think that's all they're going to say as far as giving the markets any forward guidance.
Yeah, I think the market is going to look for any hint at all on whether Powell is going to pause or not. Do you think Powell is going to give that hint?
I don't think he's going to. I think he's going to say that we're going to assess, but that is simply a different way of saying we're going to pause. The credit markets are convinced that this is the end of the rate hikes, and that at the third and the fourth quarter, we're going to get rate cuts. If you look at the credit where the bonds are and the treasuries, that's what is being predicted. So the Fed doesn't want to go that route in its rhetoric, even though I think it's probably going to get there if the economy develops as everyone, and certainly the Fed, I imagine, is expecting.
Right. A lot of people expecting rate cuts later this year, but
Right.
is that likely, do you think?
I think I think it is more likely than not, because I think the economy is slowing. After all, the Fed's purpose in raising hikes is to control inflation, but you control inflation by reducing economic activity, by reducing the job market. That's the way it works. So the Fed may not come out and say that, but we've already seen some results in the GDP numbers for the first quarter. They're 1.1% down from 2.6% in the prior quarter. So I think the Fed is not going to say all these things, but I think it's going to be evident in how it phrases the assessment of the economy.
Now, let me pose this question to you. Why would the Fed cut rates when it's seeing that the economy nothing has really broken? We have some bank failures, but it seems like from the Fed's perspective, things are not that bad. And if inflation remains sticky, I mean, why would the Fed cut rates this year?
Well, the Fed is not saying that it's going to cut rates. Remember, it's the markets, it's the credit markets that are making a bet for the future that the Fed is going to get there. The reason the Fed would cut rates, and the banking problems just add to it, is because the economy would slip into a recession or very close to. That's the reason the Fed would cut rates. But the case for it is not at all complete. And you're absolutely correct, and the Fed knows this, that inflation is not anywhere under control. And the Fed has an additional reputational problem, I think, in that they got the inflation call so badly wrong a year and a half and 2 years ago, when they were very vociferous about saying that inflation is going to be temporary. Well, the problem with calling it temporary, I suppose, is what does temporary mean? In essence, we're all temporary. Existentially, we're all temporary. So I don't think the Fed is going to be as eager as it might be to shore up the economy because of that mistaken call on inflation.
So we had the bank failure just a couple days ago.
Yes.
So let's talk about that. How do you think the bank failures factor into what the Fed will do, if it does at all? Or what do you think the Fed feels about all this?
Well, how would the Fed handle, the way to ask, they get the answer to ask the question, how would the Fed handle a widespread banking crisis? Well, it would reduce rates. So I think that's becoming another issue for the Fed. It doesn't appear so far that this is a widespread crisis, certainly that it's not going to spread to some of the largest banks, but it is already hitting all of the regional banks, not just the ones associated with the tech market, not just the ones associated with California, but all of the regional banks took a hit yesterday. So are there more problems out there? The problem so far has been largely one of perception, meaning that what happened to these banks is they lost deposits. You lose deposits, your whole balance sheet becomes a problem. So that's what's going on right now. And it hasn't worked so far that the banking, the FDIC, and the Fed actions have stemmed the perception problem.
Now, do you think the Fed will contain this if anything goes wrong, if we're going to see systemic failure among the banks? Do you think the Fed has the ability to stop that?
I think the Fed does have the ability, and the government does have the ability to control it, because after all, the government controls the source of money and they can provide as much liquidity as necessary. And that is one of the Fed's main roles, is, in the old sense, the banker of last resort. So yes, I think in that sense the Fed can, but the overall impact on the economy of another widespread banking crisis would be extremely dangerous, because the economy is not that strong despite what it seems. There are still lots of cracks and oddities, if you will, left over from the lockdowns. And I think a banking crisis would probably send the economy into a recession.
And do you think this banking crisis, these banking failures, do you think it's sort of doing the Fed's job for them, with credit conditions tightening?
Well, credit conditioning is tightening, and yes, it's the old line from Warren Buffett: when the tide goes out, you get to see who's swimming naked. The fact that a number of banks managed by people, humans, misjudged their own assets as far as what they needed to do to handle a very sharp increase in rates is not surprising. It doesn't make the result and the economic problems any less difficult, but it's not really surprising. After all, many people in banking haven't really seen a rate increase regime like this. The last time we saw this was a long time ago, so we haven't seen it. So the fact that some banks are having problems is not surprising. So I'm really not that unnerved by it.
And I think what's going to be a problem for the Fed is that inflation might be sticky at around 4%, and it's going to see that. What are your thoughts on this?
I think that's true. I think the Fed does have a problem, because if the economy continues to slow, we are headed right into stagflation, because there isn't any sense so far that there's a serious diminution of inflation. It has come off a bit. It certainly has come off from the peak, but there's still plenty of money circulating around. There's still demand. There's still probably some pent-up demand. In addition, people have jobs. There's no sense so far that even if the job creation has slowed a little bit, the jobs available have come off a little bit, and layoffs have increased, there's no sense that people are really worried about their jobs yet. If they're not worried about their jobs, they're probably going to keep spending. That will keep the pressure on prices.
And just one last thing. I'm looking at the 10-year Treasury, and it seems like it's pointing to a direction where the economy may be slowing. What are your thoughts?
I think that's the case. Well, there are two things involved here. One, I think you are seeing a response in the credit markets to the normal impact over time of a very steep increase in interest rates prompted by the Fed, and that is you get an economic slowdown. But in addition, you have to remember that the credit markets are trading markets. And for trading markets, he who jumps first often gets the best profit. So for the credit markets to be front running what they think is going to happen, even if the Fed is nowhere there in its own pronouncements, is not surprising. The two factors are involved.
All right, Joseph, thank you so much for talking to me today about this.
My pleasure. Thank you for having me.
Now, if the Fed does indicate a pause later today, it wouldn't be surprising at all to see a rally in the market.